good afternoon and welcome to today's FS Club webinar from London. I'm delighted to be joined by Sherry Madera, who's the chair of the Future of Sustainable Data Alliance, which I might call FoSDA from time to time for those of you listening. And Sherry has picked a very interesting topic. In these days of ESG, there's a lot of flack flying around, and I myself have been guilty of saying in certain areas ESG isn't quite the solution and might be the scapegoat. But Sherry's here to present a very robust and well-reasoned case on no, ESG data is the solution, definitely not the scapegoat. And I'm very much looking forward to her discussion. Now, you'll know me, I'm Michael Mainelli, I'm one of the directors of ZN, and I'm able to introduce so many webinars along with my colleagues only because the sponsors that we have who let us range widely and freely across technology, economics, and finance. And what could be more important than looking at the state of the planet and corporations within it and what they're trying to do about a whole variety of topics, not just climate change, but equality, good governance, etc. We'll be getting into that in some detail. But we thank our sponsors, as ever, for allowing us to do it. And I believe today's topic certainly fits very much in that zone. Now, the agenda will be familiar to many of you. My job is to get out of the way as quickly as possible and let you hear from our expert, Sherry. Sherry's going to be talking for about 20 minutes, and then we've got 20 minutes for Q&A. So 3 points, if I may. The first one is that the slides are already up on the website, and Peter has put into the chat room where you can find them. Secondly, I might point out that Peter will be putting more things into the chat room for you to browse while we're here. It's a very interactive session, but do be careful because Sherry has a poll coming. This is being recorded, and the recording will be up in approximately 2 working days, so sometime I would suspect before Thursday afternoon, so you can share with friends and colleagues and family and watch on the home on the home video system. But seriously, the last bit, and the most important bit, is the Q&A. What makes these webinars great fun is the ability to interact. I'll be feeding your comments, questions, observations into a discussion with Sherry. Would you please use the GoToWebinar Q&A facility, because I'm here with you, so I'm not sitting around on Signal or WhatsApp or reading my emails or text messages, so feed them in. Sherry will get all of the comments, questions, and observations with your email attached. So if you just want to talk to her directly and privately, just say so. If you want to point her to some other material, please just do so. But I will feed the questions in to the discussion with her. So with no more ado, if I may, Sherry, the floor is yours.
Well, thank you very much, Michael. A huge pleasure to be here. A topic I feel really passionate about, so hopefully we'll get a nice, robust discussion going as we move forward. And a huge thanks to the FS Club for having me. So I want to just jump right in to explain why I think this is important. So the ESG data is the solution, not the scapegoat. And this is becoming more and more relevant. As we kind of venture into the world of increasing data sets and the use of them for sustainable finance, I think what we're seeing is that there's a lot of reaction that says, actually, the data is not there yet. We don't have the data. The data is not good enough. The quality of the data isn't available. And that is actually the reality in many different cases. However, that has never stopped finance from moving forward. And it's never stopped humanity from thinking about what is the next thing that we should be continuing to pursue. So let's try and think about it from a point of view of how is it that we can make sure that we harness what we've got. And using that trite idiom to start us off, let's make sure that we don't make the perfect the enemy of the good going forward. Can I have the next slide? So I just wanted to tell you a little bit about FoSDA and about what we are going to talk about today. So why is ESG data important? I'll get a little bit more deep into that. What are the challenges? We've identified 5 different areas within FoSDA that we're looking at. And what are the challenges and what are the opportunities to use data in order to be able to pursue a more robust sustainable finance strategy? And those 5 areas are listed there. And finally, wrapping up, that point that I made at the beginning, which is making sure the perfect isn't the enemy of the good. What do we all mean by that? So before I start, I want to tell you what FoSDA is. Thank you, Michael, for truncating that. I'm going to continue to do that so we don't run over and have too many words we're tripping over. FoSDA was born in Davos in 2020. not the summer one that's just passed, but the one immediately before that, which was actually in January of 2020. And the purpose at the time was to create a coalition of the willing in order to try and understand how data was going to be a key tool in unlocking sustainable finance strategies globally. And we were really proud at the time to launch FoSDA in conjunction with the World Economic Forum, with London Stock Exchange Group, with S&P, with Bloomberg, with others who are actually very much global players in this group. But we're also particularly proud to have our NGO, our non-governmental and our not-for-profit organizations that are part of this, which include CDP, Carbon Disclosure Project, which include the CBI, which include SIFMA and GFMA, the IIF, some of the member organizations. So we feel like FoSDA is really trying to channel the view of the data community in order to be able to raise all the boats. Our view is that after COP26, FoSDA's role in sustainable finance and the ecosystem has become even more important. I think we all observed the frenetic activity that happened at COP26 and all of the disclosures and the commitments and the new recommendations that came out of that time in Glasgow. I think FoSDA's role is to make sure that we hold the world to account, that we find ways of helping us to measure and to be able to understand what it is that we are doing well and what it is that we need to course correct. So that's part of our mission statement after COP26 in Glasgow, is to contribute to all of the fantastic initiatives that are going on out there from a razor-sharp data perspective. So can I have the next slide, please? And this is where everyone has to perk up and get involved. So the audience question, and I'm reliably informed that ZN are working this behind the scenes. But the question is, what data do we need for sustainable finance to be successful, essentially? So please select one. So corporate ESG data disclosure, government environmental and macroeconomic data, ESG ratings, or do we just need more data on all ESG points? Or do we need better quality data on all ESG, better quality in all ESG data? So
Sharon, as promised, the FS Club audience are very opinionated and swift deciders. So we're well over 50% of the audience have voted already. I'm just going to leave it open for another few seconds as we get the numbers up there. And we've got most of the audience has voted, so I'll close that now and share the results with you. And it's basically better quality data in all ESG areas, and that's 60% of the audience saying that.
Great. So I think that what we're focused on here is really managing that question of quality. And maybe I can bring us all back to sort of the top level point about data. There's a number of different little adages we can use when we talk about data, but I always like referring back to the 3 V's of data, which is something that's quite compelling for everyone: volume, velocity, variety, and veracity. So I'll say them again: volume, velocity, variety, and veracity. The 4 V's of data. And I think that veracity point is exactly what the audience has pulled out there. But I think that we do need to address the other 3 V's to make sure that we actually have a holistic opportunity to support sustainable finance in volume, velocity, and variety. And that's where this presentation is going in terms of what we've learned through FoSDA. So could I have the next slide, please? So why is ESG data important? I think that we've seen a lot of different narratives about this. There's an instinctive human feeling that we need more data in order to be able to fight the climate crisis. But remember, we're talking about sustainable finance. We're talking about a financial ecosystem which is not only dealing with climate, because ESG is environmental, social, and governance. And so by its nature, those three-letter acronym, which has been around in the financial world for a long time, actually pulls in the elements of a just transition. It pulls in the elements of thinking about impact. It's thinking about sort of how it is we move forward positively and sustainably. So it's not just about climate and environment, but of course that is a huge driver. We know from the IPCC reports in terms of their data output, it is increasingly stark in terms of the effects on climate and our global warming. And of course, the tears from Alex Sharma at COP26, showed very demonstrably that, trying to keep 1.5 alive, i.e. a 1.5 increase as the maximum is going to be very, very difficult, even if all the commitments that were made at COP26 are coming through. And so channeling finance in order to be able to support sustainable and de-emphasize carbon pollutant and heavy hydrocarbon usage makes a lot of sense. And we're seeing it in the numbers. So in 2016, $22.8 trillion was attributable to what sustainable investing was defined as. And we're looking at, from even in 2020, that's up to 35 trillion. And that's all in ESG integrated funds. So it's not a incredible hockey stick, but it is growing sustainably from year to year. However, I think that, it's calling out what our audience has called out previously, that the data that underpins these ESG integrated funds, only 1% of CDP reporting companies report on all 24 key indicators. So what does that mean? That means there's a lot of data that's going into CDP and also a number of other publicly available, as well as some of the privately compiled data sets that are used by financial institutions globally. But it's very rare that each of those disclosing issuers or entities or countries or are reporting on all 24 key indicators. And that causes us some problems going forward because we're not able to create the 3 C's of data that we would want. And yes, I've done the V's, now we're going into the C's. Let's work our way through the alphabet together. The 3 C's being coherent data, comparable data, and comprehensive data. So that's where we're trying to get towards. And with this sort of disclosure, there may be one box that's ticked, but we need to get that data density significantly increased so that we can see where ESG integrated funds are going to continue to move forward. I have the next slide, please. So we've identified 5 different work streams for FoSDA. And those are, 2 of them are here. So ESG gaps and holes and forward-looking data. So ESG gaps and holes, what does that mean? That's looking at an ESG data gap, means that there's a very, very well-defined data set, but it is poorly populated. That's a gap. A hole means you don't even know which data set you should be using in order to match up to your financial requirements. If you're looking to deploy capital in a biodiverse way or supporting nature-based solutions, or trying to understand specifically how it is you're going to channel capital to a socially positive group of companies, again, there are a lot of holes that are attributable to that. And some might challenge that and say, actually, there are a lot of data sets that already are out there. Absolutely. However, what about the granularity of that data? And that's something that FoSDA is also calling out. So for example, water management, that is a very clear data point that is asked on most surveys of corporates or issuers in terms of how it is they're managing their water usage. However, one of the data sets is, do you have a water policy, a water maintenance, a water sustainability policy? Yes or no? That is the data set, yes or no. So essentially, we have a data point on that, but the question is how usable and how granular is that for making decisions that you're really trying to get behind. So we see that as a data hole. What I mentioned previously, biodiversity and nature-based solutions also are reflecting a data hole in the marketplace as that topic continues to grow in the awareness of financial services associations and groups. They don't know what data they even need. So again, we're seeing sort of an opportunity to continue to grow there, but we're also seeing a massive increase in a very cohesive and coherent data set around carbon disclosure. So carbon disclosure is becoming something that, even if it's calculated differently, data vendors and open data sources and data lakes are all providing tools by which you can make them very easily comparable. However, obviously, carbon is only one data set to consider when you're looking at sustainability, when you're looking at impact, and you're looking at transition funding. You know, I think we have some things to celebrate. This was not the case even 5 years ago. Even 5 years ago, the calculations of carbon were very different. And I think we have TCFD and other disclosure mechanisms to thank for creating a much more cohesive output there. But there's still work to do in terms of other data sets, including water, including methane, which I think we saw at COP26, is a new pledge that incorporates a huge percentage of the global governments. But actually the data that underlies it is incredibly thin on the ground. So gaps and holes is a critical piece for FoSDA to call out. Forward-looking data, again, is tricky. So one of the most pertinent findings of our review last year at the end of the year, and it came up in our annual report, that's something you can download on our website, was a gap between short and long-term data requirements. When we talk about the IPCC, so the International Planetary Climate Data Group, they are actually looking at 30 years, 40 years, 50 years plus, where those environmental aspects are coming in. This is really new territory for financial services. Typically, a financial analyst is looking very closely at what's happening between now and the next 5 years. And some are looking at 10 years. You might even get, in certain industries, a few decades on. However, in a pervasive environmental question mark, the data sets and how they're analyzed, there's a missing middle. And essentially that diagram down the bottom is looking at data from 5 to 25-year horizon. Really, there's a huge amount of data density that happens in the first 5 years and a massive amount in terms of environmentally relevant data 25 years out. But that middle section is really critical. And when we start thinking about the commitments that are being made at COP26, net zero commitments, we're all looking at 2030, 2040, that falls into that missing middle. And of course, everyone knows that auditable, disclosure-based data from issuers, retrospective data, easy to be able to get some external third-party auditing on. If you're looking at projected data, forward-looking data, you have other challenges that say, how is it that we're going to be able to utilize the same data to make some of those issues comparable? And when you give that into the hands of a data analyst, make sure you understand where that's derived from and the detail that goes behind that. Now, FoSDA has some recommendations that actually, again, take away this challenge to say, well, why don't we just mandate what it is that what that definition is? And of course, if you're talking about data, you have the wonder of being able to create some metrics that compare one data set to another. So just like in the early days of computing, now I'm probably giving away my age a little bit, you've got APIs that talk to each other. So when you're talking about sort of creating a data set that is being usable across different software sets, you have a very, very clear API so that you can translate between one and the other. Again, forward-looking data has this facility, and being able to create some frameworks for forward data specifically can help the likes of our central bankers who are looking at portfolio analysis and analyzing risk from that perspective. So again, a challenge that can easily be surmounted if we all work together to be even more clear. Can I have the next slide, please? I'm hoping I can have the next slide. There we go. This is one of my favorite slides. So one of our other work streams is about taxonomies. I just talked about defining forward-looking data. And the reality is the definition of data sets and the definition of what we're talking about and that taxonomy of what green finance is all about. Frankly, this is going gangbusters around the world. So this is not a new idea in itself. But what we've titled this is taxomania. Because we've got 42 different taxonomies that are talking about the green economy and what classifies as green or sustainable. I think everyone has heard of the EU taxonomy, and again, that has not been ratified, even though it has been put into public consultation for well over a year. And in fact, it's also been analyzed in comparison to a number of other taxonomies that have been put out into the world to see what the commonality is. The reality is there's very little commonality between taxonomies. So if we think about BlackRock, if we think about Amundi in France, if we think about Citibank's portfolios, these are all big multinational financial services players, and they have to understand where it is that they are naming their green and sustainable products. This becomes incredibly difficult if they're trying to understand which of these taxonomies to use, especially if you add the layer that taxonomies are not all driving towards the same ends. So for example, my accent belies me. I'm Canadian. I probably said out or about at some point, so you could probably have called me out on that yourselves. But the Canadian taxonomy is a high hydrocarbon economy, and it's looking very seriously about transition-based taxonomies, as opposed to the EU, which is looking much more carbon-centric in terms of its taxonomy. So again, even from the genesis of why these taxonomies have been created, it's difficult to map. That API I mentioned to you is really missing. Very recently, over the course of the last couple of months, the IPSF, the International Platform for Sustainable Finance, which gathers international ministers of finance on the topic of sustainability, has conducted a common ground taxonomy. It's an assessment of one of the first two taxonomies in the world and mapping them together. One of them is the EU's taxonomy, because it's been put out officially as being a recommendation, not that it's been taken up yet. But actually the very first one might surprise some. It's the Chinese Green Bond Catalog. They called it the Green Bond Catalog, but it's essentially a taxonomy in terms of how you define what is green. And of course, they're even moving their nomenclature from green to sustainability as well. But what that common ground taxonomy looked at meant that there was very little overlap in terms of the dark green segment of what was core. And from a FoSDA and a data perspective, then what we need to consider is what data sets do we need globally in order to be able to service the multinationals who are disclosing and the multinational investors who are trying to deploy capital and are not interested in falling foul of any of the legislation. They want to be as transparent as possible, but actually we're getting the very clear message from the investors that help them understand how these taxonomies can be used. And the view is actually taking it down a layer from the taxonomy to the data layer can provide a lot more clarity. So as taxonomies are developing, as we create an API to create a little bit more harmonization as to between jurisdictions, we can again look to those data sets and those core data sets, which are dark green that go through the taxonomies, as being a guide for global usage. Can I have the next slide, please? So all of this sounds great. However, one of the biggest challenges that we've identified at FoSDA is talent development and capacity building. So we did a study of over 2,000 international investors. And they all quoted that ESG data was being used by their firms in 92% of the cases of all of their investing, not just for ESG funds, not just for sustainability purposes, but in all of their investing. They were taking on data that was in the ESG category. However, 95% of those same respondents said that they could not find the talent that they needed to hire in-house in order to be able to utilize that data. We see this as a big problem. And if we think about the global financial centers, and of course Zian knows the global financial centers better than most, but perhaps there is an opportunity for global financial centers to really dig down on building this capacity, on building the talent that's needed in order to be able to bridge perhaps the climate-related data experts and the financial-related data experts. This is going to become even more critical as standards are developed. We've all heard of the ISSB, who are looking at creating a standard for disclosure on ESG data and metrics for the financial community. And of course, they're looking at listed companies first, but this should be extended to all companies that are seeking investment, and frankly, all companies who want to be transparent and gain market share in the market from their customer base. If they're going down that route, how is it that we can make sure that there's enough talent in the marketplace to help those that are a little less data savvy understand what those disclosures, what those data points really mean, what the risks are, and make those decisions on the basis of not just carbon good, bad, or transition good, bad, but how is it that we can support a just transition through the economy. My final point is about biodiversity. I touched on this. Biodiversity is a increasingly important topic. The Task Force for Nature-Based Financial Solutions has put together a framework on where it believes that it should have some disclosure standards from across the corporate and issuer community. Again, we're very thin on the ground in terms of data. However, being able to do a deep dive now, which we're partnering with TNFD and FoSDA, is to identify which data sets are critical. Which data sets don't actually sit on your balance sheet as an issuer, but impact nature, impact biodiversity. And getting that data into the marketplace as soon as possible allows for this layer to be applicable, as opposed to perhaps going down the early route that we went with some of the carbon disclosure, which was very unguided, and there was a lot of different varieties of what data sets were out there. Can I have the next slide, please? So I think that, in conclusion, we talked about the perfect not being the enemy of the good. I gave you a lot of challenges in this presentation, but I also want to make sure that everyone is aware that disclosures are going from voluntary to mandatory rapidly across the financial institutions regulatory space. FoSDA is working with 17 different regulators around the world, asking questions about what data is available. This is how I want to regulate it. This is how I want to promote transparency. How is it that we also start making sure that the environment is right for increased quality data? So I think that we are on a really, really steep curve that is going to increase the quality and the density of that data globally. And we shouldn't talk about that data is completely the problem. Data is something that's going to continue to move. We're going to continue to grow. At a compound annual growth rate is predicted that data is going to grow 22% year on year from 2021 to 2026. If we're waiting for 2026, we're going to be missing the boat on climate. So essentially, the message here is let's try and make sure that we're actually not asking necessarily for more data and that we need more data. We need to make sure that the use case is appropriate for the data we have and that the density is there. My last point, Michael, let's make sure that when we do that, what we're doing is we're trying to mitigate the 3 E's. If we don't have the data, we're in danger of extrapolation, estimation, and that leads to errors. And that's where we have to make sure that we're protecting all of ourselves. Otherwise, the money's going in the wrong place. So thanks very much for listening. I'm sure that there are a lot of questions. Hopefully, some of them I might be even able to answer.
Well, Cherry, that was great. And I know it's a big topic area to ask you to cover in 20-25 minutes, but you did brilliantly. We have a lot of questions and comments and observations, but do keep them coming in. It's interesting that you end on this slide, which reminds me of the absolute oceans of data that we're overwhelmed with. And there's a lovely quote from Herbert Simon, who was a sort of a computer science economist. What information consumes is rather obvious. It consumes the attentions of its recipients, and hence a wealth of information creates a poverty of attention and a need to allocate that attention efficiently among the overabundance of information sources that might consume it. And that leads me, I think, nicely onto probably a good opening question from Hugh Purser, who is saying, Sherry, are the 24 key indicators really relevant to all businesses? Might it be more useful and easier to administer to have companies report on, say, the top 10 or the top 5 indicators which are most relevant to their business or footprint?
Yeah, great challenge. And actually, this is the core work of our ESG gaps and holes work stream this year. And actually, of those 24, we've identified 21. So we haven't pared it down too much, but the 21 that we've identified stretch across from a corporate investor and portfolio management perspective. We've also identified actually that there are 10 different but overlapping data points if you are looking at investing in the sovereign marketplace. And again, this goes to the point of use case. So if you understand where it is you're trying to what you use your data for, then I think that you can get a lot more specific about those use cases. However, I think the models have gotten so complicated now that it's almost impossible to get below those 21 in order to also meet compliance requirements.
Now, another issue that raises its head is you touched on the problems with the taxonomies. MIT had a kind of a wider study which started publishing about 3-4 years ago and continues today, and it's called Aggregate Confusion. where they are quite damning on all of the various ESG studies as being incoherent when looked at as a whole. Any thoughts on that study and work, and how complementary is that with what you're trying to do?
Yeah, I think that what I'd call out there is it's about sort of ESG ratings, I think is where we're going. And I think that anyone can Google that, even that phrase, and the tsunami of news is incredible about challenging why we have credit ratings that are very, very much aligned in the marketplace as a financial tool, but ESG ratings are incredibly disparate. And it's an ongoing debate. From a FoSDA perspective, actually what we believe is that if we've got the data that's visible and transparent, then being able to have even more tools, even more ways of being able to pull tools and data sets and methodologies off the table gives a sophisticated investor, gives a financier the tools that they need in order to move forward. So, the abundance of variety basically means that we have to, at this point in the curve of development and journey, we have to be less sanguine about just accepting what that rating is. We need to understand what it was built for. Is it built with a just transition in mind? Is it built for carbon? Is it built for example, more impact related? And they are all different. So we have to put a little bit more graft into understanding what those tell us, and then they become incredibly powerful.
Edwina Morton, who was a former editor at The Economist and also past master of the World Traders, asks, she points out, what gets measured gets managed is one phrase you often hear. The implication is that therefore such things can be improved. But what gets measured can also lead to mismanagement or missing the point, call it brainwashing perhaps. One might also think of Goodhart's law. Is there not a risk that the emphasis on data as the root of all ESG judgments can lead to poor outcomes or missed opportunities? For example, not all companies will thrive on the same governance structure. Yet to get a tick on some of the ESG ratings, certain structures are required. What's the room for subtlety, judgment, and might I even add evolution?
Yeah, I mean, I guess I hearken this back to, we're not starting from a standing start. And if we're looking at data for financial services, and we're looking at data for sustainable financial services, we're getting a bit more specific there. But financial services data, you're not only your balance sheet, but everything that you're putting in terms of an annual report, it does need to be the same as what was called out here, which is it needs to be fit for purpose. And so part of the financial analysts nous and their talent is trying to understand where that matching works. And I think the thing that's going on now that I'm heartened by is the fact that we're talking about industry specific data sets that are much more required. For example, in the energy sector versus the fashion sector versus, for example, the built environment sector. And that is a huge amount of work. The Sustainable Markets Initiative, and that's been started here. It's championed by Prince Charles, but it dives into industry-specific data sets that are needed and how it is that those can be comparable across the industries. I think that's where we need to go in order to be able to, answer that question, which is, one size doesn't necessarily fit all, but so has it been always for financial markets data. So I think that we can actually navigate that well, as long as we have the talent to do so.
We've got a lot of questions, so we'll have to be short, I think. But Paul Phillips is curious, who do FoSDA see as best placed to audit the veracity of the ESG provided?
Yeah, it's a good question, but there's a lot of companies that are already out there, and I think that it depends on what you're auditing against. Again, you need, if you're disclosing to CDP as an example, or now that or so some of the other sort of groups that are consolidating data, you have groups already in place that are looking at sort of being able to have a third-party independent verification for that. I guess the better question is, can we make that so that it becomes a global standard? A little bit, more along the lines of where we are with our accounting standards, US GAAP or whatnot. And I think that that's where the ISSB is trying to go. At the same time, I think that trying to get that standardization is going to take us some time. Unfortunately, we are in this betwixt and between, that we're going to be able to get this veracity and this verification and this auditing that's being done on the basis of how it is that the questions are being asked to companies. And you're going to still have to create that comparability between the different standards that are out there right now. The biggest question and hope is that ISSB just doesn't become one more standard as opposed to ruling them all.
Now, we've had a lot of discussion about people micromanaging through ESG, and last month BlackRock, which had voted in favor of 47% of environmental and social shareholder proposals in 2021, said it was going to roll back quite significantly. Larry Fink didn't want to vote for things that were in their assessment implicitly intended to micromanage companies. So that's one danger, I think, from ESG. How would you respond to that?
I think that we're seeing sort of ebbs and flows, because that same investor came out pretty strong that they were going to use that sort of data to micromanage companies even just 2 years ago. Mm-hmm. So I think that what we're experiencing right now is the reality of the macroeconomic environment. So we're seeing our post-COVID, the numbers that are coming out of most countries in terms of growth for this year, for next year, for the year after, are far from robust. And so I think that there is some stepping down from the aggressive stance of using ESG in order to be able to direct the actions of underlying businesses.
And we had another
direction of that travel can be quite depressing, though. So we have to sort of manage where that's at.
Hugo Innes, something you and I spoke about in the green room raises, was Elon Musk's attack on the S&P ESG index methodology fair? You know, after Tesla fell out of the top of the index in favor of other car makers, after he claimed ESG was being, weaponized by phony social justice warriors.
It's a great quote, isn't it? Well, I think it's one of those. This is one of those things that we have to remember. It's an ESG score, so it's not just environmental. When people think about Tesla, they think, "Wow, that that obviously is doing some great good." However, it's also the S and the G. And if we look at those scores, it's very transparent on these scores and methodologies that S&P has, and they are really falling foul of the governance mechanism by which the index is put together. And again, there are questions there. Is the index properly put together? However, S&P is running, a very long-standing business in this piece, and they have their justifications and their transparency, and they're not the only ones in the market that are running these indexes. So again, comparability between them is important for investors to consider. Also, if you really look at it, Tesla is not reporting its carbon emissions. And frankly, that's something that being called out by being pulled out of an index, that might be something worthwhile doing.
Well, ZM created a good governance index with the Institute of Directors a while back, and I remember we got a lot of flack from a lot of ESG specialists because of Carnival. And Carnival had one particular outlier, which is the way its chief executive and chairman was being paid. But in almost all other respects was model, and you just saw the emphasis of the weighting depending on where this particularly G model was coming from. Now, Eleanor O'Higgins asked a question, how does all this stuff that you're doing relate to the achievement of the UN Sustainability Development Goals and their accompanying target indicators? Sort of a question really for me in a related sense is, have you done a mapping of your 24 areas and how they balance, and are there holes or gaps, or is that not the way to look at it?
Yeah, I mean, this is work that's underway, so I'm glad that it's getting interest. It gives me the smell test that we're on the right track for sure. The 24 indicators are a CDP metric, so to be clear, the ones that FoSDA FoSDA are looking at are comparing against various regulatory regimes and what investors are demanding. And we're able to look at this from our own data, and the data is coming from the fact that we have all the world's largest data vendors as part of the FoSDA network and are able to share in aggregate which data sets are being utilized most frequently for which purposes. So again, that's where our data is coming from, and that is sort of what's governing where we're thinking about things. However, you know, are we sort of unifying that, you know, in the whole, and are we actually channeling that to SDGs? FoSDA isn't yet. You know, for us, we're really very focused on looking at sort of how the financial regulators around the world are utilizing data and understanding what data is available before they start implementing new regulations. That's our real mission statement, is to create a positive circle so that what we're seeing is that regulation comes into play, but it's based on the knowledge that data is available. And if that data isn't available, that regulation is phased in order to be able to allow those that are being supervised to be compliant, rather than creating incredible friction in the system and causing a huge amount of toxicity. So that's where we're more focused. I think the SDGs, yet another acronym, hugely important and impactful. How they're working in, we're still working it out.
Just to return to climate for a minute, and we'll have to be brief, but you know, your website, your opening, you know, all emphasized climate. You spoke about COP26. So three sort of questions I think we can string together. The first one is from Christopher Gleedle. Thank you for a great presentation, Sherry. But how do you measure decisions foregone that would help compare effectiveness of impact disclosure over time? What positive, and this is from Clive Bullen, what positive current data have you seen that supports global warming not damaging the planet and human beings? Are there any other positive data in ESG? The vast majority seems negative. And from Drago Injik, are any examples of biodiversity and soil databases? In fact, I might take in a fourth one. Christopher Williams, did you feel COP26 was a success? So
that's a lot. Let's take them through. Did I think that COP26 was a success? I didn't, because I think that it was far too much jazz hands, and that adage that was mentioned before, how do you measure? I think that was pretty wholly absent. So how is it we're going to know if we're going to be successful or not? That's my biggest worry. I think that's its biggest failure. The second question was about data on soil. Yes, there is data on soil. However, it is not comparable, and it's also quite legacy. So again, that velocity of data in the 4 V's is lacking in that data set. And often it has to be paired with a reliable geospatial data, so that we are tracking sort of that link back to ensuring we know exactly where that data sampling and that sourcing is from. So again, that's critical, and I don't think we've joined that up as well as we should yet. Michael, remind me of I was working my way backwards, and
you're doing superbly. It was about the positive stories out there. Do you have any that you can share?
I think that the positive story is that the carbon disclosures that are coming out are significantly more cohesive. And so there needs to be a lot less manipulation in terms of what those numbers are saying, so that they can be more easily comparable. And the density there globally on carbon emissions, greenhouse gas emissions, and the detail behind that is very encouraging. Does it mean that it's going in the right direction? Not necessarily so. I think what we are seeing, which you could argue is a positive, is increasing availability of verified, and again, I put that in my bunny ears quotes, carbon credit opportunities that are not just in the energy sector, that are also starting to get reflected in some of the other big polluting sectors like agriculture. And I think that that's encouraging for us. I know that it's a hot debate as to if carbon credits are the way to go. But if it is, at least we're starting to get a little bit more density, variety, and hopefully verification that goes into the system. And I think that there was a question as well about impact.
Yeah, it was about, well, actually, I'll wrap that up with another one. So the question that you're referring to was from Chris Gleedle about measuring decisions foregone. But Jim Foster makes a point about your missing middle. You know, how do we start to get entities to define and publish these interim targets? We've got the short term and the probably unrealistic long term. You know, but you want these forward-looking middle targets. And what can we do to encourage it if we've got ESG turning up at AGMs and, you know, vague statements of intent in 2050. We're sort of missing the practical engineering bit of a 3 to 5, 6 year project.
Yeah, and I think that in some ways this goes back up to that question about measurement. And frankly, this I think could be very, very worthwhile work that a COP type structure could put together, which is what is it that we're measuring in our forward-looking statements? What are some of the reference points that we all agree on globally in order to be able to tack some of our corporate disclosures too? Otherwise, it is like shooting in the dark, because if we're not all talking about the same sort of levels of how it is we're predicting things going forward, again, how meaningful, how useful is that data going out? And we all, need to be aware that the disclosures in this scenario are corporates that potentially also have earnings reports that are quarterly, that are due, that have CEOs and boards that have fixed terms sometimes. And we all know that there is, there is an issue there in governments, in corporates. If you only have a certain amount of tenure, what it is you're saying in the 5 to 25 year bracket, maybe someone else's problem. And actually, we need to shift that around to make it everyone's problem, because net zero at a country level isn't going to be achieved unless we've got net zero at a corporate level and a personal level.
It's interesting. Yesterday, I chair an investment committee, and we were having our ESG discussion with our investment advisors. And of course, defense has now wandered. And I think it's important people realize that these are living uses. It shouldn't be too rigid. I detect quite a strong amount of sympathy from the audience as we start to wrap up here. And I can see the thanks coming in, which is always gratifying. It's also a reminder to me I need to close. But one of the things that I think I'm seeing is real support for the general idea. But probably wavering off into two areas. One is this bit about making sure we are measuring the right thing. Like there's a comment here from Joe Zamet-Lucia, I'll just read out. Credit ratings may be aligned, but the global financial crises since 2007 showed just how poor they are and how conflicted are the rating agencies. So rather than a mechanistic approach, perhaps we ought to let companies describe their own narrative. Now there'll be people who immediately object to that and say it's outside, and then we move on to the other extreme, which is the auditing. And there's a point here made by John Taylor, as a co-founder of a small center concentrating on the legal facilitators of sustainability. There must be consistent and comparable regulation globally. So we've got these two extremes, but basically up the middle, I don't see how you can object to more data, but we then move on to how we use it, which is where we go from here. So may I say, firstly, 3 rounds of quick thanks. One to our sponsors, as ever, superb and kind to allow us to go across all these topic areas, but I think they would agree that ESG is very, very core to what we're all trying to achieve. I would also like to thank you, the audience. As ever, the website contains all of our forthcoming events, so just go to the website and check them out. We actually have 2 on Thursday. One's a little early, 8 o'clock in the morning, but we do have Professor Fan Gang, who's on the Monetary Policy Committee of China, giving us the Chinese view of the global economic outlook, which would be absolutely fascinating. He's been on this program a few times and has done a marvelous job in presenting the Chinese case for things. But very finally, of course, the person I really want to thank is you, Sherry. We have been unable during 2.5 years of lockdown to come up with a way of measuring applause. So I have here my Korean karmic clapper, and that will have to do as best we can. But the very, very kind comments coming in here indicate how happy everybody was that you could spend some time with us this afternoon. Thank you.
Thank you to you, Michael, and thank you to the audience.